Celcom Digi Berhad was formed from the merger of Celcom Axiata and Digi Telecommunications, making it the largest mobile service provider in Malaysia by customer base. Celcom is known for its strong nationwide coverage, while Digi is popular for its affordable plans. By combining these strengths, Celcom Digi offers better network quality, wider coverage, and competitive pricing. The company provides mobile, fixed, and enterprise service and serves around 20 million customers, playing an important role in improving Malaysia's digital connectivity. Maxis Berhad, founded in 1993, is one of Malaysia's leading telecommunications provider. Maxis focuses on innovation and continuous network upgrades to ensure reliable service. It offers mobile, fiber broadband, and digital solutions through the Maxis and Hotlink brands, and is widely recognized as a premium provider supporting Malaysia's digital economy. Celcom Digi targets a very wide market because it has the largest number of mobile users in Malaysia. Its main focus is on the mass market, especially prepaid and postpaid customers who want affordable and reliable mobile service. Many students, young adults, and daily users choose Celcom Digi due to its competitive pricing and wide network coverage. In addition, Celcom Digi is also targets home users through fiber plans and small business that need basic digital solutions. Overall, its target market is broad and includes almost all types of consumer. Maxis, on the other hand, targets a more premium market. It focuses on customers who value high service quality, stable internet speed, and advanced features. This includes working adults, families, and users of higher-end postpaid and fiber plans. Maxis also strongly targets enterprise and corporate customers by offering digital solutions such as cloud service, cybersecurity, and IoT. Celcom Digi focused strongly on improving its network after the Celcom Digi merger. One of its key innovations is building an integrated nationwide network that combines the strengths of both companies. This helps improve coverage, speed, and service reliability. Celcom Digi also invests in 5G expansion for mobile internet and home broadband. In addition, the company develops digital tools such as self-service apps, digital identity systems, and cloud service for small business, making digital access easier and more affordable for the mass market. Maxis, on the other hand, focus on premium technology solutions. Besides expanding 5G and fiber broadband, Maxis invests heavily in enterprise innovation. This includes cloud computing, IoT, cybersecurity, and smart business solutions. Through partnership with global tech company, Maxis supports digital transformation by helping business adopt advanced technologies like automation and data analytics (IoT).
My name is Umi Aisha bin Hanafi and my metric number is A2483310. So, when we look at the competitive landscape, we see two different strategies. Celcom Digi is playing the scale game. With over 20 million subscribers, they are focused on becoming the volume leader. Their current priority is a massive network integration that aims to deliver up to 800 million ringgit in annual savings by 2027. Maxis, meanwhile, is focused on value defense. They are protecting their high-end market share through premium branding and advanced digital solutions. While Celcom Digi spends on integration, Maxis is investing 1 billion ringgit annually into enterprise growth and infrastructure. In short, Celcom Digi is striving for massive efficiency while Maxis is doubling down on premier experience. Product and service portfolio differentiation. Celcom Digi is focused on mass market convergence. By using the Celcom Digi One plan and all the digital smart brand, they are bundling mobile and fiber to make their massive customer base stickier. Their focus is on providing accessible digital tools for the SME market. Maxis, however, differentiates through high-end ICT. While they use Zero-Lution to lead in customer bundles, their real edge is in the enterprise space. They provide specialized high-margin solutions like AI, cloud, and IoT for large corporations. In short, Celcom Digi is scaling digital access while Maxis is leading in complex corporate transformation. Let's look at financial outlook. Celcom Digi is a story of short-term investment for long-term gain. While integration costs are currently impacting profits, the big prize is an 8 billion ringgit synergy benefits expected by 2027. They offer investor growth through massive scale and sustainable dividends. Maxis, in contrast, is the safe haven. By avoiding merger complexities, they maintain high margins and stable cash flow. Their focus remains on tight cost control and reliable returns. In short, Celcom Digi is a play on future upside, while Maxis is a play on immediate stability.
Hi, my name is Nofarahani binti Johari. My metric number is 82483342. So today I will explain about the ratio analysis about Celcom Digi. For the current ratio is decreased from 0.49 in 2022 to 0.46 in 2023 and fell further to 0.1 in 2024. For the quick ratio decreased from 0.47 in 2022 and 0.42 in 2023 and reached its lowest point at 0.39 in 2024. The average collection period decreased from 73 days in 2022 to 44 days in 2023, but then increased to 61 days in 2024. The account receivable turnover increased from 4.96 times in 2022 to 8.24 times in 2023, but then decreased to 5.93 in 2024. The inventory turnover increased significantly from 6.04 times in 2022 to 11.41 times in 2023 and continue to increase slightly to 11.54 times in 2024. Then the debt ratio increased from 0.50 in 2022 to 0.54 in 2023, but then decreased sharply to 0.12 in 2024. For the time interest earned ratio of 5.20, 25.23, and 4.19 indicate that the company is able to meet its interest obligation in all period. Next, the total asset turnover increased from 0.81 to 0.35, showing improved efficiency in using total asset to generate revenue. For the fixed asset turnover was 1.06, 11.23, and 1.93, with the second period showing very high efficiency in utilizing fixed asset. For the gross profit margin, increased from 61.26% to 78.29%, indicating better control over production costs. The operating profit margin remains strong at around 21%, although it showed a slight decline in final period. For the net profit margin increased from 11.27% to 12.96%, showing that the company overall profitability improved after all expense and tax. Next, the operating return on asset from 4.55% to 7.62%, indicating that the company used its asset more efficiency to generate operating profit. The return on equity increased from 4.75% to 10.36%, which means shareholders are earning higher returns on their investment.
Good morning, madam. My name is Tiong Moon Hui. My matrix number is A24A3258. Today, I will present about 2.0 financial ratio for company Maxis. First of all, is liquidity ratio. Current ratio, they are decreased from 0.63 times to 0.52 times from 2022 to 2024. Second, quick ratio. They are decreased from 0.62 times to 0.52 times from 2022 to 2024. Third, average collection period, they are decreased from 46 days to 43 days from 2022 to 2024. Besides, account receivable turnover, they are increased from 7.98 times to X.40 times from 2022 to 2024. Inventory turnover, they are increased from 0.75 times to 3.82 times from 2022 to 2024. For capital structure ratio, their debt ratio, they are increased from 0.72 to 0.74 from 2022 to 2024. Times interest earned, they are decreased from 4.14 times to 3.9 times from 2022 to 2024. Next, asset management efficiency ratio. For total asset turnover, they are increased from 0.42 times to 0.47 times from 2022 to 2024. Fixed asset turnover, they are increased from 1.74 times to 2.07 times from 2022 to 2024. Therefore, profitability ratio, gross profit margins, they are decreased from 30x.76% to 30x.30%. Operating profit margin, they are decreased from 18.50% to 17.82%. Net profit margins, they are increased from 12.06% to 13.25%. For return ratio, they are operating returns on asset. They are increased from 7.86% to 8.41%. Last, return on equity, they are increased from 18.54% to 23.64%. That's all from me. Thank you.
My name is Gautam Xuan, matrix number A24A3275. So this table shows the liquidity position of CelcomDigi and Maxis from 2022 to 2024. Both companies experienced a declining current and quick ratio, indicating weakening short-term liquidity. However, Maxis consistently maintained higher ratio, suggesting relatively stronger liquidity management. The average collection period and receivable turnover for both firms were volatile, reflecting fluctuation in credit efficiency. Inventory turnover improved steadily for both companies, indicating better inventory control. Overall, where inventory efficiency improved, both firms faced challenges in maintaining strong short-term solvency. This table analyzes leverage and asset efficiency. CelcomDigi debt ratio declined significantly by 2024, reflecting a better capital structure. In contrast, Maxis maintained a relatively high but stable leverage level. The tax interest earned ratio for both firms fluctuated, indicating variability in debt servicing capacity. In terms of efficiency, both companies showed improvement in total assets turnover, while Maxis demonstrated more consistent fixed assets utilization. Overall, CelcomDigi reduced financial risks, while Maxis achieved stronger operational consistency. This table evaluates profitability performance. CelcomDigi maintained a high and stable gross profit margin, reflecting effective cost control. Maxis experienced greater margin volatility but recovered in 2024. CelcomDigi's net profit margin increased steadily, while Maxis saw sharper fluctuation and overtook CelcomDigi in 2024. Both ROA and ROE improved for the two firms, even though Maxis displayed higher volatility. Overall, CelcomDigi demonstrated more sustainable profitability, while Maxis achieved higher but less stable return.
Moving to our strategic recommendations for CelcomDigi. First, we need to improve cash flow. We'll do this by moving short-term debt to the long-term and cutting unnecessary operating costs. This creates a bigger cash cushion while we handle the merger. Second, we must collect payment faster. Our goal is to get paid within 45 days. We can achieve this by using AI to spot high-risk account and offering reward for customers who pay early via our apps. Finally, we need to move inventory quickly. By streamlining our supply chain, we ensure we are left with outdated phones and hardware. Then, we need to turn our massive asset into revenue. By using our newly unified network, we can drive high margin growth in home fiber and digital service. After that, we should maximize our existing hardware. We can do this by sharing infrastructure with partners and focusing on low-cost tech like IoT to get more value out of what we already own. Sixth, we must leverage our fortress balance sheet. Because our debt is so low, we can secure cheap, long-term funding for 5G expansion while still saving enough cash to pay out dividends. Finally, we will use AI and automation to keep our operation lean. This ensures we always have a strong financial buffer to cover our interest and protect our profit. Moving forward, we will boost our margin by combining vendor contracts to save costs and shifting our focus to high-value software service. Then we must stay on track to hit our 8 billion ringgit synergy target. This is key to pushing our shareholder returns into the elite 15 to 20% tier. And lastly, we will move toward an asset-led model. By removing all network equipment that doesn't support our 5G rollout, we ensure every asset we own is actively driving profit.
My name is Nur Izzati Zainal. My metric number is A24A3433. Today I would like to talk about revenue recommendation for Maxis and how to improve their organization. For current ratio, implement stricter account receivable management to boost cash flow. For quick ratio, monetize underutilized asset to increase immediate liquid cash. For average collection period, use predictive modeling to identify and collect from high-risk account faster. For account receivable turnover, simply financing processes to accelerate customer payment cycles. For inventory turnover, optimize stock level to match real-time demand and reduce idle capital. For fixed asset turnover, focus investment on high revenue infrastructure like 5G and fiber. For total asset turnover, sell or repurpose non-performing asset to maximize total revenue generation. For debit ratio, rebalance capital structure to reduce reliance on high interest debit. Time interest earning, improve the debit equity mix to ensure profit easily cover interest costs. For gross profit margin, target high value SME and enterprise segment for higher margin revenue. For operating profit margin, lower OPEX by renegotiation, vendor contracts, and streamlining retail branch. For net profit margin, combine cost cutting with digital service growth to improve the bottom line. For return on asset, adopt an asset-light model by prioritizing digital and software service. For return on equity, optimize capital efficiency to provide predictable and attractive shareholder dividends.
Firstly, Celcom Digi's main internal source of funds come from the merger synergies. After the merger between Celcom and Digi, the company is expected to generate around RM700 to RM800 million in annual cost savings after 2027. As a result, Celcom Digi is able to free up significant cash flow without increasing financial risk. Secondly, Celcom Digi is shifting its focus toward high-margin digital and enterprise service. Instead of relying heavily on low-margin hardware sales, the company is expanding into cloud security, managed private network, and 5G enterprise solution. These services offer higher profitability and provide recurring revenue, which strengthens the company's long-term internal funding capability. Lastly, Celcom Digi is expanding its presence in the B2B and SME markets. By targeting business customers, the company benefits from lower customer acquisition costs and more stable income compared to the highly competitive prepaid consumer segment. Next, I will explain Celcom Digi's external funding strengths and financial position. First, Celcom Digi has a strong balance sheet with low financial risk. In 2024, the company recorded a very low debt ratio of 0.12, meaning that 88% of its assets are financed by equity. This shows that Celcom Digi does not rely heavily on borrowing and is financially stable. Second, the company has a strong ability to service and risk debt. Its times interest earn ratio is 4.19 times, which means Celcom Digi can comfortably meet its interest payment. This gives confidence to lenders and allows the company to raise low-cost debt when needed, especially for large investments such as the national 5G rollout. Finally, Celcom Digi practices strategic capital expenditure management. Although current CAPEX is higher due to merger integration, these costs are expected to decrease once integration is completed. In the long run, the estimated RM8 billion net present value from synergy benefit will strengthen cash flow and support long-term financial stability.
My name is Raja Nufana binti Najib Muhammad Khalil Faizal and my metric number is A24A3150. So I will continue by advising Maxis on the most suitable sources of fund for easy expansion. Maxis should carefully manage easy funding strategy due to easy weight liquidity position. The current ratio declined to 0.52 in 2024, indicating potential short-term liquidity risks. Therefore, Maxis should prioritize non-debt funding to avoid additional repayment pressure. In terms of capital structure, Maxis already has a high debt ratio of 0.74, although easy time interest earn ratio of 3.90 shows that interest expenses are still manageable. Lacking or more debt would increase financial risk, especially during the capital-intensive 5G expansion. Hence, reliance on bank borrowing should be limited. The most suitable source of funding for Maxis is retained earnings, supported by strong profitability with a return on equity of 23.64% and an improved net profit margin of 30.25%. By retaining more profits instead of paying high dividends, Maxis can finance expansion at no cost. Additionally, Maxis may consider equity financing, such as a right issue or private placement, to improve liquidity without fixed repayments. An asset-light strategy through sale and leaseback of tower assets can also generate cash without increasing debt. That's all. Thank you.